Well, it's a pleasure to be here again, and an honor. And I have to give special thanks to Mr. Not really for organizing everything and so on, that has already been done, but actually for correcting a number of misunderstandings I had. You see, I'm not in front of you as a guru. I'm not in front of you as someone with omniscience. I'm here because I'm also trying to learn and bring something of what I know to bear on a discussion with you. And I hope this is going to be a long-term discussion. And that's what we're setting up. It's a very long-term discussion. So, like what Mr. did to me, I hope to get from a number of others. And he said, no, you should look at it in a different way. Of course, I'm not thanking him for that in a way, because that's what Bram said, that he forced us to actually rewrite virtually the entire Sri Lanka presentation. So I'm grateful to him for that. Now, what we're going to do today is no more than a taster. And we would claim, especially on the global economy, but also on the Sri Lankan economy, this is something you have never seen before. If you have, I'd like to know where. Okay? And I don't mean that rhetorically, I mean it genuinely, because we have not seen this before. But this is something we have been using ourselves for quite some time. We also invest on the basis, so whatever I'm saying to you, I've invested on the basis of that. Although I have a fancy suit now, I'm not a rich person. So I'm not super successful with everything that I've researched, but we actually invest in everything that you're about to hear I'm invested in. And that's because I really believe in what I've researched. This is not just a presentation to you. And I'm coming back to Sri Lanka because this is my home. I feel an affinity to Sri Lanka, more than an affinity. Okay, this is where I want to spend, in a way, the last years. I'm now coming towards retirement, and I want to really contribute something. Whatever I can, I want to contribute. But I want to do it in a way that is useful. I know you have attended lots of seminars. It's a very normal thing in Sri Lanka. There's plenty of seminars. After a while, attention goes off to something else because you're all very busy people. So I'm very grateful that you've spent the time, but I hope really every time you come, you get something out of it. It's a bit of a difficult journey, but I assure you that we do have something to present. And let's see, as we're going along, let's see. We're splitting it into two. One part is the global economy, the other part is the Sri Lankan economy. The starting point is the globe, because as I'm now repeating what I said last time, everything that happens in Sri Lanka is conditioned by the global environment. Sometimes we behave as if Sri Lanka is not only a geographic island, but also an economic island, which is simply untrue. Okay, so we need to see what's happening in the global environment, because there are, as some of you who have come to the previous presentation know, there are quite dramatic things happening in the world economy. We'll mention a couple of these things. So the first part we do on the global economy, and the second part we do on the Sri Lankan economy. One thing that I'm not going to do is to provide roadmaps for the Sri Lankan government. Okay, that's not my job. They have plenty of people doing that, and very competent people as well, and all of you here, I'm sure, are also giving your 5 cents worth to the Sri Lankan government, and are far better placed than me. We are monitoring. We are saying, this is what we see. This is what the data is telling us. And that's all we can really do. It's useful. It's useful because we have a certain take on it. But please don't misunderstand, because people are always asking, since I came back, they're saying, oh, so what do you think about the government's policies? No, sorry, I don't know what those policies are. Do you? I don't think anyone so far knows what those policies are, so no point in me actually just speculating. And that's not our job. Okay, so the second part is actually to say, what have been the longer term trends, and what do we see currently the situation for Sri Lanka, and giving you an idea where we see the road to possible success. Okay? There's no one road, there can be several roads. So that's basically what we're doing. In the first part, when I did the last presentation, someone said to me, well-meaning. This person said to me, you know, Howard, the thing is we are reading lots of articles in international newspapers. We've had lecturers coming here and giving us presentations on the global economy, and so on and so forth. What are you adding? And I tell them, everybody has underlying what they say a certain perspective on either the global economy or the Sri Lankan economy. And underlying perspective is what matters. It's what you focus on, which is particularly important. Let me just give you an example. I think I've mentioned this before to you. I had a very rich Dutch investor friend. Maybe you met him once, no? His name was Rick Karma. Okay, he invested in Sri Lanka, and he invested all over the world and so on. And he was a friend. So every time he went to any particularly important meeting in Europe, he asked me to go along with him. In 2009, there was a big investor forum in Marbella in Spain. And there we had lots of economists, some from Harvard, some from Stanford, one from Cambridge University, all talking about printing money, because 2009 was when the Fed, the US Fed, started to print money in a massive way. I don't know if any of you recall it, but to try and get the world out of the crisis it was in. And all these people came, and why the investors were so concerned is we teach everyone, and we have taught everyone, if you print money, you get inflation. All of you have heard of this, isn't it? If you print money, you get inflation. It's a mantra, even in Sri Lanka, 1990s. Print money, inflation. Ask any central banker, they will tell you, print money, get inflation. So all the investors at that forum were panicked. There was a Harvard economist, and he predicted, on the basis of what the Fed said they were going to print, 1,000% inflation. Kenneth Rogoff was his name. 1,000% inflation. His advice to everyone is sell bonds. Sell government bonds, because they'll be decimated in the inflation tidal wave. My friend asked me, what do you think, Howard? And I put it bluntly, hopefully not too arrogantly, I said they're talking nonsense. That this printing of money is going to lead to an increase in asset prices, not prices of goods in the shop. And there will be no inflation. In fact, my prediction was deflation. I told him, when everyone else is selling bonds, you buy. And he made a small fortune out of it. And he asked me later, he said, how is it you know this? And he said, please pardon me if I sound racist, but you are a Sri Lankan nobody, he told me. In this room are all the elite of the Western universities. How do you know what they don't know? You know? And I told him, because I use common sense. This is nothing special. In the business community, you have plenty of people using common sense. In fact, I do know that lots of business people did not rush like lunatics and sell bonds. So this is why the underlying theory is so important. Lots and lots of people know there's printing of money, they will have lots of opinions, but you have to always ask them the question, what is underlying your forecast? You've come here, you've given us a forecast, but tell me what your thinking is. Okay, so this is why it's very important. This is why these underlying perspectives are very important. Okay, so we're going to look in the global economy. So the bit you're not going to get, because this is a CEO's forum, and we've had to take out bits because it's very short, we always link economic growth to equity markets, always. Always link inflation to interest rates, that we will do. And usually we have balance of payments and currencies. But in this case, there's a very important discussion going on about the future of the dollar. Where is the dollar going? And we thought we'd just give a couple of bits and pieces on that. This is our starting point. Basically, our thinking is this. When we want to know about the health of all economies in the world, we study growth, economic growth. Because when the world economy is growing well, all countries do fairly well, Sri Lanka included. When the world economy goes down, it doesn't matter what your government policies are, you will go down. Okay, maybe a bit less than others, maybe a bit more, but you will go down. You will go down. Nobody escapes. As we can see in the 2009 crisis, the world goes down, and everyone goes down with it. But the question is, what drives growth, economic growth? That is, the production of the whole economy, what drives it? And for us, and this is uniquely us, it's manufacturing. Sometimes you can't see the difference. Can you see this? Manufacturing and economic growth. You can't see the difference between the two lines, because wherever manufacturing goes, services goes, and the rest of the economy goes. It's the driver. The question is, what drives manufacturing? And this is where we are different to everyone else. This I've presented before, I will repeat it, because it's still not there in most of the literature. Now, this argument I've been making now for a decade. So I started telling people, watch China, because something very big is about to happen. China is going to become the world's factory. Can you see? So the red lines, this is as a share of world manufacturers, who dominates the world. I have to go to the screen because apparently this doesn't work on LED screens. Okay. China comes from nowhere. This is 1998. As a share of total world manufacturing, China is under 10%. The dominant parts were the US, Europe, and Japan. But over time, the Chinese have risen. To this point, what I want to show you is that China now accounts for the same proportion of manufacturing as US and Europe combined. Okay? It drives everything in the world. When China sneezes, the world catches a cold. When China boosts its economy, the whole world rises, especially the developing world, because China accounts for about 45% of all raw materials bought in the world. 45%, because they're the factory of the world. And what they do is they buy all the raw materials throughout the world. And what this means is whenever China is doing well, all developing countries do well. When China is doing badly, then the rest of the world does badly as well. So now, when I came here last time, you remember, I was thinking there's going to be a global recession, because this was what we all saw. Can you see that? Okay, we saw actually a lot of weakness. Even though I came here, we didn't have this data. We didn't know that China was going to recover. But what happened was the trade war between the US and China. Now China is going into negotiations with the US. Chinese philosophy is never go into negotiations unless you do it from strength. So the Chinese thought, if we have a weak economy, we can't negotiate. And what the Chinese did then, what the Chinese did was they ran a monster budget deficit. Can you see this? 2019 January, I didn't have this data when I was speaking to you. I didn't realize the Chinese had opened the taps. Massive. This is as a percentage of GDP. They put this huge budget deficit in and drove up their whole economy at the cost of an increase in debt, huge increase in debt in China. But now China's economy is rising, and I'm going to show you while the rest of the world is actually falling. Not developing countries, but actually the other advanced countries are getting weak. But China is very strong. If China hadn't done what it did, we would all be in a global recession at this moment. But they lifted the whole world out of recession. Now, they did the same thing in 2016. I don't know if you all remember that there was a tremendous weakness in the world economy. The world economy was going down very fast, stock markets were falling. The US economy went down to 0.5% growth, and the Europeans came to 0. There was a big conference in Shanghai, G7. China was asked, actually by Obama and Merkel, China was asked to take the whole world out of recession. We don't know what China was offered, but the idea was, the thinking was then, if the US gets into recession, the Democrats would not win the presidential election. Okay, so this is in February of 2016. The theory was, if the world economy would revive, then Hillary Clinton would win the presidential election. We don't know what the Democrats promised the Chinese. We know they promised them something, but we don't know what it was. As it turned out, Donald Trump wins. You know? Now, the Chinese were pretty unhappy because they injected this massive stimulus in a way that revived all the world economy. Can you see what has happened? This is global imports. When China injected this amount of money in 2016, they bought a lot of the world's exports. So the imports rose massively. Now, you remember I just showed you China has run a budget deficit again. What has happened to imports? They haven't recovered. Because China this time is saying, no, the money is all for us in China, not for the West, because the West betrayed us. You know? So they are not reviving the world as they did before. This is all domestic expenditure. United States, 1920s, did exactly the same thing. And that is why Europe suffered badly. The US injected a huge amount of money into the economy, but made sure it remained in the US. The Chinese have done the same thing. And that's why the Chinese basically have recovered, as I showed you up there, here. Can you see? The Chinese, what they've done is they've invested heavily in infrastructure in China. You may have seen the figures on Chinese fast trains, okay, the high-speed trains. Okay, massive increase. The Chinese have now started building, well, you know, the Road and Belt Initiative, you have seen this, but they've also started building literally thousands of bridges in China. They've started constructing huge industrial areas in China, all reviving the Chinese economy. In a way, you can see the growth of capital goods production has surpassed even the period of 2016 because they wanted to negotiate with the Americans from strength. The result has been massive increase in debt. But when we go back and look at the rest, the Europeans and the Japanese and the Americans, so we take all the rest of world production together, what we see is there's been no revival in Europe, nor in Japan, and now we see the US is starting to go down. So we think now that Europe is in recession. Take note of what I've just said. Europe is going into recession. Where does the most number of tourists come from in Sri Lanka? Europe. And we know once Europe goes into recession, we've seen it in the past, tourist arrivals from Europe fall. Not immediately, because it's always with a lag, isn't it? I think the booking is 6 months ahead or 12 months ahead. I can't remember exactly the time period, but definitely Sri Lanka will feel that because Europe is in trouble. USA is also now possibly facing trouble. Many of you who may be looking at the international press will see two different groups arguing it out. Are we going into a world recession? Has anyone here seen this diagram? This is what is called the bond inversion. This is the 10-year US government bond interest rate minus the 3-month yield. You can see, I don't know if we've got it here, but every single time, usually we had the shaded thing. The shade has gone, I'm sorry. But every time it has gone down below this red line, there's been a recession. Every time. There's no exception since 1950. Okay, so it's actually the best predictor we have of a recession. And this has now happened. Okay? And it's always, after this happens, it can be anywhere from 3 months to a year and a half lag. But more or less mechanically, after that happens, you're sure to get a recession. So this group is saying there's definitely going to be a recession in the United States, as there now is in Europe and possibly in Japan. This group is looking at this and saying, no. Here is the economics and the stock market. This is world gross domestic, so world growth, and the world stock market index. So it's all the stock markets in the world put together. You can see where growth goes, the stock markets go, because both are linked to profits. Profits, investment growth, profits, dividends, equity prices. Okay, so they're both linked by the same force. And that's why they move together. Here, what we've done is we know there's always a lag. First the stock market moves, and then you see economic growth moving. So if we believe this relationship, the rise in the stock market recently is telling us that next year is not going to be a recession. That for some reason or another, the world is going to be saved. But I'm going to show you in just a second why that may not be true. Okay, so that's where we are with growth. Inflation. We teach in the universities inflation is caused by printing money. You remember I told you that? If that is true, why is it that world inflation moves always so close with world primary commodity prices? Why is that? You know, what we have found is that primary commodity prices are absolutely vital. Remember this when I come to Sri Lanka, because I'm going to show you something quite remarkable also with Sri Lanka. The world moves with primary commodity prices. The question is, what drives the movement of primary commodity prices? China. Who buys all the primary commodities in the world? China. When China is growing, what happens to primary commodity prices? Rises. When China weakens, what happens? It falls. So China is driving world growth and world inflation. Once you know that China is recovering, you can see world inflation. The last 3 to 4 months, we've seen world inflation rising. No one actually knows why. Everyone was forecasting it was going to fall. And that's because people don't watch China. You know? Everyone is watching the US or Europe, but they're not watching China. China is very important. Why is this important? So this is where we try and make a little bit of money with our knowledge. We know one very important relationship over time, and that is where inflation goes, interest rates go. I see amongst you a lot of bankers. If bankers don't know this, I don't know who else knows this, but we know that inflation and interest rates are intimately connected. We can see this in the US. This is over very long periods. You see, when the trend inflation rises, trend inflation falls, the interest rates rise and fall. If I know that when the trend is going to fall, I have one investment, the best investment that there's ever been: buy bonds. If you bought 30-year US government bonds in 1980, you know what the interest rate on them was? 17%. You'd be sitting on 17% 30 years later. Can you imagine the capital gain you get? We're now coming to the bottom. We know the next 20 to 30 years is going to rise. What's the best bet we can make? Borrow everything you possibly can borrow now, long term. Because you know in 20 to 30 years, interest rates are going to go back to 15 to 20%. You know that because we're in this long cyclical process. Borrow, so wait for the property crash now. It's coming. If our guess is correct that there's going to be a global recession, property prices are going to fall. Borrow whatever you can, long term, 30, 40 years. You know what the mortgage rate in Europe is at the moment? 30-year loan, do you know? 1.5%. 1.5%. Half of that you get back from tax. So you're paying 0.75% for 30-year loan. When did that ever happen? Okay, but wait at the moment because we know asset prices have bubbled. Okay. We have one further small relationship I want you to remember and bear in mind, that the US federal fund rate always follows the 10-year Treasury yield. Always follows that. So when it has risen over the long period of time, the US federal fund rate is the core rate of the US economy. It's very important for Sri Lanka. I'm going to show you something really important that explained an anomaly that was seen in Sri Lanka just 3 months ago. Okay, I'm going to show you an anomaly that has not been seen up to now, and I'm going to show it to you in just a moment. It's the federal funds rate. Last thing is on the dollar. All of us are trying to work out where is the dollar going in the future. This is absolutely fundamental. All currencies in the long term are linked to only one major variable, and that is the competitiveness of a country. And that is manifest in the trade balance, always. Whenever a country's trade balance goes negative, then the currency is always under pressure. It's always going to get weak. All those countries with positive trade balances for any significant period of time always have strong currencies. Japanese yen, straight after the Second World War, was 360 yen to the dollar. Japan has consistently run trade surpluses since the Second World War. What is the yen today against the dollar? I think it's somewhere like 112? No, 108, sorry, it's 108 now against the dollar. So from 360 to 108. China, 1995, RMB against the dollar, 12 to 1. China has consistently had a trade surplus. What is the Chinese currency to the dollar now, today? 6.9? Okay. So we know this is a basic iron law. We should see, because this is the US dollar, the US trade balance over a very long period of time. The US, somewhere around 1955, becomes world money, meaning that most central banks in the world held dollars and not pounds. From the time they became world money, the trade balance weakened because the US had no need to be competitive. All they needed to do was print money. And that's why they've consistently had a trade deficit over a long period of time, which means that we should see the dollar weakening consistently. That's what we should see. We did see it weakening from this period right through to here against the major currencies, the Deutschmark, the yen. I say the Deutschmark, today we talk of the euro, but then it was the Deutschmark against the yen, and now recently against the Chinese currency. But the problem for us today is in the last 6 years, the dollar has been strong. Why has the dollar been strong? And here is the reason. That especially Europe and Japan, they actually moved their interest rates far away from the US. Can you see the Japanese, this is the red line, its interest rate started to be much lower than the US and Europe, already from around 2000 onwards, okay, even before 2000 onwards, because the Japanese economy was weak. They were running a trade surplus, so they didn't want their currency to be very strong. And what they did was they then reduced interest rates to push capital out of the country and balance the supply and demand for yen, so that the yen didn't become strong. Remember, trade surplus, strong currency. The Europeans stuck with the same interest rate as the US until around 2012. Now we have a huge difference between those as well. The Europeans dropped their interest rates to near zero. So Japan has zero interest rates, Europe has zero interest rates, but the US has around 2%, 1.8 to 2%. So what we should be seeing, what we do see, is basically a huge net inflow of capital to the US, which is propping up the dollar. That huge net inflow is because of the interest rate differential. And it's not only Japan and Europe, but it's countries like Switzerland as well. Norway, that is outside the euro. So all this money keeps flooding into the US. Can you see the net capital flow position, what's happening is money is absolutely gushing into the US. And it's accelerating into the US, propping up the dollar. But this is not sustainable. Because once the US starts to weaken, which is likely to happen soon, then the interest rate differential is going to start shrinking. And when that interest rate differential starts to shrink, then the dollar is going to come under tremendous pressure. So I don't think the dollar is going to get stronger. My bet is actually a one-way bet. I'm now betting that the dollar is going to weaken against the euro and the yen in the not too distant future. And once it starts weakening, it's possible that it's going to accelerate. So my offer to you is I will not come back to Sri Lanka and do any teaching if I'm wrong on this point. Okay, because I lost all my money, so I can't afford the airfare. We just put it here, just to make it much clearer. When the European interest rate decouples, you can see all this money flooding into the US makes the dollar stronger. This is the dollar against the euro, yen, and British pound. Because the British interest rates have also fallen together with the European, and all this money coming from the UK, from Europe, etc., has propped up the dollar. That is likely to end. That's all boring stuff. Let's get on to Sri Lanka, the center of the universe, isn't it? I mean, who gives a damn about all this Chinese? Okay, deep breath. You okay? Okay, no problem. Right, so we're going to not do much on the equity market again, but we are going to concentrate a little bit on interest rates and the currency. Now, we start with growth. And this touches on, of course, growth strategies and so on, but we start again. Like with the world, if I want to know where Sri Lanka's GDP is going, I have to look at the world. I have to look at the world. That's my starting point. Because, as I said, Sri Lanka is not an economic island. If there's weakness in the world, Sri Lanka goes down. See, weakness in the world, Sri Lanka goes down. What we are now saying is perhaps we're headed for recession in the world. Doesn't matter what this current government does, Sri Lanka is going to go down. Which is why I would say, don't blame the government if Sri Lanka goes down when the world goes down. I mean, there's nothing they can do. People actually think governments can perform miracles. It doesn't matter which government is in power, they cannot do much about it. My question is, what drives Sri Lanka's growth underlying this link to the world? And this is not very popular because we have all these different theories in Sri Lanka, but I can only look at the data and see one thing very close driving growth, and that is manufacturing. There was only one major deviation that I could spot, and that was here. That was when the previous Rajapaksa government brought the Chinese in, and we went for a massive construction boom. Okay, it was short-lived because construction cannot sustain a growth process. But basically, the message that I get is manufacturing growth. You know, nothing else. And Sri Lanka, because it's not an economic island, has to have exports. If it's manufacturing that is driving Sri Lanka, then it has to be manufactured exports. It cannot be anything else. So if that engine is not strong, and this is what we see, this is one of our best indicators of an engine, is export value as a percentage of GDP. You can see over a very long period of time, so you can't blame any one government. Over a very long period of time, the export value as a percentage of GDP has been falling, falling, falling. It means the export engine is weak. It means it's a very weak engine. And there, while Sri Lanka has done well relative to the world, because really it's relative to the advanced countries, like all other developing countries, it has underperformed. So this is Sri Lanka relative to the world. It's rising because all developing countries always grow faster than advanced countries, always. But we're underperforming the other Asian developing countries, so India, Pakistan, and East Asian countries. We're underperforming them. And the question is, why is that? And I go back to exports. Why is this export engine so weak? Well, the dominant part of that export engine is garments and textiles. The other part we have is agricultural goods, but this is still the dominant part. And when I compare Sri Lanka's competitiveness with its major competitors in Asia in garments and textiles, see, Sri Lanka is the blue line. Sri Lanka is by far and away the weakest. It has lost competitiveness in this area. And that's where I'm working in Vietnam, and I've spoken a lot to Vietnamese business groups and so on, and I ask, why are you so strong? Why are you so dominant? And, after them praising themselves for their competitiveness and so on and so forth, they admit it's government. It's government facilitating their increased competitiveness. And it's not just government giving concessional finance, it's not just government giving tax breaks, it's the whole institutional structure. For example, the government finances the shipping. They have followed the Koreans. The Chobuks, the Koreans, basically, they have collective shipping, like the Chinese. It's the state that actually bears the costs of transportation of the goods. And like this, you see so many incentives given to their producers, which Sri Lankans don't have, or they have some, but not many. We also had a look at why has the Sri Lankan economy not collapsed then? And here, the most obvious one is tourism. So we can see the earnings from tourism as a percentage of GDP has risen from 1% to 5%. That's a very major contribution of tourism. So this is not to belittle tourism. Without tourism, Sri Lanka would have been in quite a desperate state. But we have to ask the question, can tourism seriously take Sri Lanka forward? Is there not some limit to tourism? And then we ask the question, so where are all the exports going to, and where are all the tourists coming from? So let me look at the export destination. This is, of course, very important. We're going into a global recession. Europe is already probably in recession. If this is my export market, I'm in trouble. I'm in trouble. If the US is following suit, I'm in trouble. China is very small at the moment. Should be bigger. One of the pieces, the statistics that I didn't give you, which should be known, is we know that by 2025, China will be the biggest market in the world. By 2025, China will actually be at least 20% bigger retail market than the US. By 2030, it will be at least 35 to 40% bigger than the US. So if one is actually thinking seriously about export markets, you better start thinking of China. The other one, incidentally, is India. If the growth projections on India and its retail market are correct, India will be the second largest market by 2050. Second largest, bigger than the United States, bigger than the United States. That is a study done by Standard Chartered Bank, which is worthwhile looking at. I'm not sure about the assumptions, but this is an even bigger problem. If so many tourists are coming from Europe, and Europe is now headed into recession, we're in trouble. We're in trouble. You know? So one has to look at that, not panic, but I think there's a case. I mean, I have to divulge, I've been paid by the tourist organizations here to say this, but I think there's a case for government finding ways to relieve the tourist sector, because they're going to be cash-strapped. Definitely they're going to be cash-strapped in the not too distant future. Once the tourist arrivals start to seriously collapse, and if you're going to have a serious strategy on expanding tourism, you don't want the hotel industry damaged at this moment in time. You know, you want them to have enough money and enough liquidity to maintain services. Okay. How are we doing on time? I'm going to finish in about 10 minutes. Inflation. Remember, how many central bank reports have you read here? Inflation is caused by printing money. Remember how many times we've heard this? And remember why this is important, because if that is true, then automatically it has implications for interest rates. So the bankers amongst you must be seriously thinking, well, you know, I need to look at those printing numbers. Do you have an econometric model of that? Understand, here is something staring you in the face, and somebody wants proof with the model. You know, this is where we have gone crazily wrong. You know? I mean, this is just absolute common sense. But very important, incidentally, if you are a banker and you're trying to forecast interest rates going forward the next 1 year, and we are talking about a global recession, what's likely to happen to primary commodity prices? Down. And therefore, what's likely to happen to interest rates? Down. You're a company that needs to borrow for 6 months, 1 year, etc. Are you going to borrow now or wait? You know, exactly. Exactly. This is why this is extremely important stuff. But we don't do that because actually we have paid a heavy price by listening to the economists who come with stuff that doesn't work. But here is something that is very straightforward. Now, one thing that we can see in Sri Lanka, and I'm now coming on to this piece of terrible controversy. When I was last here, there was a governor of the central bank called Indrajit Kumaraswamy, a very honorable person, a personal friend of mine going back a long time. But he's grayer than me, you know that? Have you seen him? He's much grayer. I told him that when I met him as well. And he said, Howard, before I took this job, I had black hair. You know, he was grey after he took the governor's job. You can see there's a very good relationship between the repo and the inflation rate. And so there should be. This is where the controversy occurred. Inflation fell last year, end of 2018, going into 2019, and Indrajit puts up interest rates. You remember all the slanging against Indrajit? But there's one thing that was missed in the discussion. I'm going to show it to you now. The US federal funds rate. You see, what the US did was they started to aggressively raise the federal funds rate. You see here, this is the Sri Lankan repo that Indrajit raised. Why did he raise it? Because the US kept raising federal funds rate. If Indrajit did not do that, there would have been a currency crisis. you know, actually had to do it. And countries all over the world did the same thing. And the central bank governors in so many countries were hammered for exactly the same problem. Because in their own countries, inflation was falling, but they had to raise the repo rate in their country. Because the US raised it. Why? Because Sri Lanka locks the rupee to the dollar. It's a very simple thing. If you have locked the rupee to the dollar, your monetary policy is set in the US. You know? So you have to watch this very carefully. And that's actually a warning to the present governor, because you have only certain freedoms, certain flexibilities. Because supposing Indrajit had not done this, you'd have had a currency crisis in Sri Lanka. So this is why it's actually extremely important to understand those relationships. I hope some of you will go and tell Indrajit, because he's complaining that I didn't defend him enough. Okay, so the last thing we have is the balance of payments and the exchange rate. And this, of course, is the perennial worry. Remember I said any country with a trade imbalance, a deficit like this, will always have a weak currency. The only way you ever have a strong currency is if this is above that red line. And then you won't constantly be fighting that rearguard action to defend your currency. This is partly compensated, must be, because the current account is not as bad as the trade account. So there must be flows that compensate for the trade imbalance. And those flows we know quite well, are foreign remittances, so all the migrant workers in the Middle East remitting, and that's a huge amount. Although it's now down from its height, at its height it was 9% of GDP. We're now down to about 6.5% of GDP. But still, it's a massive amount compensating. It's actually what gives the government that leeway not to do very much about competitiveness in Sri Lanka. Second thing we have seen is tourism, the travel revenues. Okay, so now here, since I've been here, people say, Howard, you know, you're talking about manufacturing all the time, but you're missing the fact that there's IT going on in Sri Lanka. And the IT sector is really making a big contribution. Maybe, but not to foreign exchange earnings. See, this is the line where it's other services. See this light blue line? It's other services. But in terms of what it's earning for Sri Lanka, it's not that much. And it's actually not so much more than it was in 2004. So I don't really know where the IT has had an impact, but it is certainly not earning foreign exchange at the moment. It may be in the future, I don't know. But at the moment, I don't see it. What I can show you is, I'm going to compare Sri Lanka with all developing countries. And what I've repeated many times is that countries that are into manufacturing aggressively always have surpluses on their current account. The countries that are into raw material production or non-manufactured activities always have current account weaknesses, and they compensate by having migrant labor and etc., etc. Sri Lanka is even lower than the raw material producers. They have a weaker current account than the average of even the raw material producers. This is the sub-Saharan African countries. This is the Latin American countries. Usually when this happens, you supplement by borrowing, foreign debt. And this is basically what I'm starting to get worried about. I'm starting to get worried that every time there's a problem, Sri Lanka borrows more in terms of foreign loans. So you can see that there was a period of time that the foreign borrowing diminished. Now it's starting to rise again. And from what I hear, I think it's going to rise again further. And this is the problem with that. This is the problem. In 1996, actually it was in 1995, I think Manu, you will remember this, that we had a big conference about liberalizing the capital account. You remember that time when a new president came in, Chandrika Kumar-Natunga came into power, and they asked the IMF to come in. And as everyone knows, I'm not very happy about the IMF at the best of times. But I went to, so I had the view that Sri Lanka was not going to go very far with IMF advice. And then we had a lot of people who invested on the basis of our advice. That was a consult. And they asked me to go and find another alternative. And the first country I went to was actually Thailand. And when I went to Thailand, I was studying their balance of payments. And I noticed this phenomenon, the income account deteriorating. The trade balance weakening and the income account deteriorating. This is debt servicing. This is foreign debt servicing. There comes a critical moment, see, we're now at the point of the lowest. So this is the biggest debt servicing we've had, foreign debt servicing. And I noticed this same tendency, but more dramatic in Thailand. So this is not dramatic, but a sudden deterioration in the income account. What happens is the country becomes insolvent. They're borrowing too much, and they cannot service that. So we always watch this, because it was the one thing that I was watching on the Argentinian scene in 1999, before Argentina collapsed, when I was also advising somebody. We noticed exactly the same phenomenon. There were always two things going together: a weak trade account and a weakening, constantly weakening income account. Because at a certain point, the thing snaps. And then the collapse comes. I came back to Sri Lanka. That's where my guru status came from. And I told many foreign investors, don't touch Thailand. It makes me nervous. So 1996, going into 97, was the Thai financial crash. Because of this phenomenon. Because it's an accident waiting to happen. Now, I'm assured that the present government has seen this and knows this and is worried about it. Is worried about it. So that's all that matters in actual fact. If they're not negligent, and I'm told that they know about this and they're taking this into account. The problem is, where are the foreign exchange earnings coming from? Tourism? Maybe. But remember what we have just said, that Europe is going down. And therefore, that's unlikely to do much. IT, I don't think so. And then foreign remittances of migrant labor. That's also very static. If there is a global recession, one thing we know is, it's a chart I didn't have, that every single time there's been a global recession, Sri Lanka's budget deficit goes through the roof. It has to. Now, taxes have been reduced. Where is the space now to have that large budget deficit? There's only one alternative. Is there's going to be more foreign borrowing. And if there's going to be more foreign borrowing, this could well deteriorate. So one has to be very careful. It's not apocalyptic, because the fact that the policymakers are aware of it is very important. And it's when they're unaware and blasé about the situation that it worries me. But they are certainly aware about this. But this is something we monitor. And this is the very last chart that you're given. interest payments on long-term foreign government debt as a percentage of the foreign exchange reserves. And this indeed is again very worrying, because the interest payments have now moved up to nearly 30% of the reserves are required for servicing debt. Because that is not very good. That is a very frightening situation. And it's rising precipitously. This government has just come into power, so they can't be responsible for this. Okay, but it doesn't mean to say that they're not stuck with a certain problem. And this could become a very serious problem if we go into a global recession. This is the only thing that one says. Somebody asked me, so what is your forecast for the Sri Lankan rupee then? Do you have a crystal ball? I don't think so. My forecast is this, that if this is the situation, and there is weakness in the trade account, and there's not much prospect of increasing foreign exchange earnings at the moment, and there have been all these boosts in expenditure by reduction of taxes, I think there's going to be pressure on the balance of payments and the currency. Now, I don't believe this government is going to allow the currency to fall in any dramatic way before the parliamentary elections. Okay, I may be wrong, but I don't think so. But after the parliamentary elections, what's our bet? Okay, I would hazard a guess that there's going to be a lot of pressure on the currency after the parliamentary elections, unless a deal is done with donors who are going to come in and lend Sri Lanka a lot of money at concessional rates. At concessional rates. It has to be at concessional rates. That's it. Thank you. Thank you for your patience.